statements summarize the performance of a business for an accounting period in monetary terms. By performance, we typically mean profits earned in an accounting period and the value of assets owned by the business. The commonly reported financial statements are trading and profit and loss account and balance sheet. Financial statements are commonly known in India as final accounts. These statements are prepared typically at the end of each accounting period. So, the first financial statement that we are going to look at is what is known as trading account. Now, the trading account compares the performance earned from selling the goods and services with the cost of getting the goods or the services ready for sale. It is always prepared for an accounting period, typically 1 year. Revenue earned from the primary activities of the business like sale of products or services is recorded in the trading account. Only direct expenses incurred on getting the goods or the services ready for sale would be recorded in the trading account. So, the trading account has net sales, that is gross sales minus sales returns, and closing stock on the credit side of the account. On the debit side, we record the opening stock, net purchases and all direct expenses incurred to get the goods ready for sale. The difference between the debit and the credit side of the trading account is the gross profit or loss earned by the firm for that accounting period. Now, if credit sales is higher than the direct expenses, the firm is considered to have earned a gross profit. Otherwise, it is a gross loss that is reported for the period. Now, gross profit or loss is transferred to the profit and loss account in order to calculate the net profit or loss earned by the firm for the period. Profit and loss account is a statement that is prepared to know the net profit or loss earned by a business during an accounting period. In the P&L account, all the other costs of operating the business and the non-trading revenue get accounted, along with of course the gross profit or gross loss. The net profit is always the difference between revenue and expenses. So, if the total revenue of the firm is greater than expenses, the difference is recorded as net profit. On the other hand, if the total revenue is less than the expenses, the difference is reported as a net loss. The format of the P&L account is shown on your screen, and you can see that it has the gross profit and all non-trading revenue items on the credit side. The indirect or the non-operating costs of running the business are recorded on the debit side of P&L. As you can see, the difference between both the sides is recorded as net profit or net loss. The net profit earned by the business for a particular period is added to the capital account in the balance sheet, because the profit earned by the business rightly belongs to the owner or the shareholders of the business. Balance sheet is a statement that shows the financial position of a firm as of a particular date, typically the last day of the accounting period. By financial position, we mean the value of assets owned by the business and the value of liabilities owed by the business to the third parties. Unlike trading and profit and loss account, which are prepared for a period, balance sheet, as I mentioned earlier, is always prepared as of a particular date. The information in the balance sheet can be presented in two formats: order of permanency and order of liquidity. When the order of permanency is adopted, assets are presented from most permanent, that is the fixed assets, to the least permanent or the current assets. Liabilities are presented starting from the most permanent, that is the capital or the equity owned by the shareholders, to the least permanent, which is the current liabilities. When a company prepares the balance sheet as per order of liquidity, assets would be presented starting from the most liquid, which is the current assets, to the least liquid asset or the fixed assets. Liabilities on the other hand are presented starting from the liabilities that have to be paid off in the short term, that is current liabilities, to the long term liability or the capital. Now, sole proprietorship and partnership firms can follow either the order of permanency or order of liquidity while preparing balance sheet. A balance sheet format prepared as per order of permanency is shown on your screen. Remember, the total in the liability side should always tally with the total of the asset side. Now, companies that are registered as per Companies Act 1956 have to follow the balance sheet format specified as per Schedule 6 of the Companies Act. The format that companies normally follow can be seen on your screen. The information disclosed in the balance sheet is not very different from the earlier format that you saw. The only difference is in the format of the financial statement and the sequence recommended by the Companies Act. Now, one other financial statement that is prepared by companies is what is known as the profit and loss appropriation account. In this account, all non-operational adjustments that affect the distribution of profits to the shareholders and the company are recorded. Some of the items that are recorded in this account are any transfers to general reserve, proposed dividend, interim dividend, amount withdrawn from the reserves. As you can see in the sample account shown on your screen, the net profit computed in the profit and loss account gets transferred to the profit and loss appropriation account, and the closing balance in this account is added to the capital or the equity account in the balance sheet.